All right, today we're going to pull back the curtain on a part of the financial world that is just massive, super influential, and well, operates just out of sight. It's like a parallel universe that plays by its own set of rules. We're talking about shadow banking.
I mean, we all know what a bank is, right? It's that familiar building on the corner, the place you keep your savings, where you go for a loan. It's a system we pretty much all interact with. Simple enough.
But what if I told you there's this other system out there, a parallel one, that does a lot of the same stuff, but without any of the same rules? Yeah, so what exactly happens in its shadow?
Okay, so what exactly is this system? This financial world that's kind of hiding out, just outside the regulatory spotlight. Let's break it down and get a really clear definition.
Okay, so here's the deal. Simply put, shadow banking is this whole network of financial players that, for all intents and purposes, act like banks. But they aren't. They do the same basic job, connecting people with money to people who need money. And this is the huge part, they operate outside of all that strict government regulation and the safety nets that regular banks have. That's the key takeaway here. They're playing a similar game, just with a totally different and, a much riskier rulebook.
So you've got to be asking, why does this system even exist in the first place? Well, to really get it, you have to look at it from two different angles. Think of it like a market. We've got the supply side and we've got the demand side. Let's start with the supply. Why traditional banks, the ones we know, are often the biggest players in this shadow world.
So look at this. On one side, you have your traditional banks. They are wrapped up in some pretty heavy regulations. Things like Basel III, which basically puts a cap on how much borrowed money they can play with. That's what we call leverage. And because they play it safe, they get access to government safety nets if things go wrong. But then, you look at the other side, the shadow banks. They basically get to sidestep all that regulation. This means they can take on way more leverage, make much riskier bets, and why? All in the hunt for higher returns. It's that classic trade-off, less safety for the chance at a much bigger payday.
But it's not just about the banks chasing bigger profits. That's only half the story. There is another huge driver for this whole system, and it comes from a problem that might sound kind of weird. It's the problem of having too much cash.
Now, seriously, just try to picture this for a second. Imagine you're in charge of the cash for a giant company, a huge investment fund, maybe even another country's central bank, and you have, let's say, 10 billion euros in cash, just sitting there.
The single most important question on your mind is, where do you park all that cash, even just for overnight or maybe for a week? Where can you put it so you know with 100% certainty that it will be absolutely safe?
Now, your first thought is probably, just stick it in a bank account. But for these massive players, that's a total non-starter. Why? Because those government safety nets that protect our regular deposits, they have a limit, a cap. In Europe, for example, that insurance only covers up to 100,000 euros. That's it. So let's do the math here. You deposit 10 billion, and the bank goes under. You are guaranteed to get back 100,000. The rest? It's at risk. For these guys, that is an absolutely unacceptable gamble. No way.
So what you have is this incredible, massive demand for safe, liquid places to park cash. We've established that regular bank deposits are way too risky for these amounts. And you might think, well, what about short-term government debt from a super stable country? And that's a good thought. But the problem is, there just isn't enough of it to go around. The global demand from all these huge cash holders completely outstrips the supply.
And this is where shadow banking steps into the picture. It becomes the perfect marketplace, the perfect matchmaker. It connects the two sides of the story we've just laid out. You've got the financial institutions on one side, chasing those higher returns by dodging regulations, and on the other, you've got these giant pools of cash, desperately looking for a safe harbor.
So what's on the menu in this marketplace? Well, you can think of it exactly like that, a menu of safe, money-like assets that they create to meet all this demand. The three big ones are, first, you've got repos. These are basically super short-term loans that are backed by solid collateral like a government bond. Second, there's asset-backed commercial paper, or ABCPs. That's short-term debt that's backed by a whole bundle of other loans. And third, you can buy shares in money market funds. These are just investment funds that only buy safe short-term stuff. So for our friend with 10 billion euros, these products become the new go-to alternative to a regular old bank deposit.
Okay, so this system, it seems pretty neat, right? It solves a big problem for everyone involved.
But there's a catch. There is a fundamental, deeply hidden risk that is baked right into the very structure of this thing. Let's peel back that layer and look at the inherent mismatch at its core.
All right, first, let's look at the money flowing into the system. Where does it come from? Well, it comes from those things we just talked about on the menu, the repos, the ABCPs, the money market funds. The key thing here is that these are all extremely short-term. We're talking sometimes just overnight. The investors putting their money in expect to be able to pull it out on demand, instantly, just like you would with a regular bank account.
Okay, so what do the shadow banks do with all that on-demand cash they've just borrowed? They turn around and invest it in much longer-term assets, things like government bonds, corporate bonds, and this is really crucial, they buy a lot of things called asset-backed securities, or ABS. Now what are those? They're these complex financial products that are made by taking thousands of individual loans, like mortgages, car loans, you name it, and bundling them all together into one new security.
And right there, that's the core of the problem. You're funding your business with money that can be yanked away at a moment's notice, but you're putting that money into investments that are locked up for the long term. This is what financiers call a maturity mismatch, and what it creates is an incredibly fragile system. It only works as long as you can keep rolling over that short-term funding day in, day out without any interruptions.
And this leaves us with one absolutely critical question. If this whole giant system is built on this fragile foundation of confidence, what happens when that confidence suddenly evaporates? What happens when those long-term assets, especially those super complex asset-backed securities, suddenly look a whole lot riskier than everybody thought they were? You know, this isn't some hypothetical classroom question. This is exactly what triggered the 2008 global financial crisis, a catastrophic chain reaction that started right here in the shadows.